People coming in the room here, welcome to the economic and market update for the quarter. And so grateful that you guys would take a few minutes out and join us and let us share some of this information with you. And I see people that I've known, a lot of names I don't know from around the country, and grateful that you would be here. I'm Kurt Brown, Chief Investment Officer here at Town Square, joined today in the room here by several members of the investment committee, but on the call today with me will be Josh Flade, one of our heads of credit, and a kind of the co-head of the investment committee here with me. So we'll kind of go back and forth on some of this stuff. We got a lot of stuff that we want to go through. There is a lot going on. There's a lot of things that are happening that fly in the face of economic textbooks, right? I studied economics in college, and we're rewriting some things. So let's go through them. We've broken the presentation up into kind of like three basic simple blocks, right? The bad stuff that's going on, the good stuff that's going on, and then, where do we go from here? Like, where does this take us? And as you've heard me talk about before, my wife's been a TV journalist for 25 years, and financial journalism is not really totally journalism. So it's hard to get just good, really core data. And we talk to a lot of you. We manage money for over 1,000 high net worth families around the country. That includes a lot of business owners in a lot of different industries. We like to share the info, what we're seeing, what we're hearing from you. We of course, talk to a lot of money managers that we partner with and hear their feedback of what they're hearing from the businesses they invest in. So we try to use this as a gathering place for this type of information and not really through a lens. We don't really have a bias on the information. We just want to give you data and let you see kind of what's going on under the hood. So since the first of the year, the US stock market made a high on January 4th. Since then, we've been trying to digest several things that all really came in short succession, right? How desperate does Putin get, right? The commodities disruption, whether it's crude oil or wheat. We'll talk about that. We went from a period of good inflation into now bad inflation, right? And the Fed's job got a lot tougher. And when you add like this weird European war in the middle of that, that makes things even a little bit more complicated, because you could see a situation where you quickly go from a lot of inflation to even like stagflation or deflation, right? If things spiraled out of control over there. So the Fed's really got their hands full. And then ultimately, how does this affect earnings? Can you keep up these unbelievable profit margins that our US corporations have been loving for many years with the cost of everything that's going up? All right, so I want to bring Josh into the conversation now and talk about the elephant in the room. Inflation is the issue, right? I mean, you turn on CNN at night, we're going to talk about Ukraine and Putin. It's a humanitarian disaster. It's awful. The images are terrible, but we're going to put that aside and talk about things from an economic and global capital market standpoint, how it affects people's portfolios and whatnot. So you have some things prepared on inflation. Why don't you kind of walk us through? We're all hearing that there's all this inflation, but why don't you give us a little bit more color kind of on what you're seeing?
Yeah, and it is. And I think you phrased it perfectly. It has become much more complicated than it was even 6 months ago. And we'll walk through some of the Fed data later on, and that bleeds into everything that's going on in the Fed. But the picture of inflation has become much blurrier, but I think the fundamentals are still there as far as inflation starting to get lower towards the second half of this year. It's just that everything that's going on, the geopolitical risks, everything that's happening there has definitely made things harder, and it's going to stretch out inflation longer.
And I think it's important too, Josh. It's funny when at times like this, when everything feels heavy, right? The cost of everything is going up. We have a war going in Ukraine. It's easy to forget that the reason we're having the inflation and the rising interest rates is because the economy is so good.
Yes.
It's so good, right?
Great job market. Yes.
And so we talk about these heavy things, and sometimes it's easy for us to forget the reason we're having the problem actually is because the economy has grown so much.
The fundamentals are still pretty strong. Yeah, for sure. So what we're seeing now, we're definitely seeing a broadening of inflation, right? Food, housing, airline tickets. I'll show some specific data on this. It is all of those things have gone up, and I think we've all felt that as you go and you go fill up your car at the gas station. We already knew energy was a big deal. It's now an even bigger deal than it was even a couple months ago. I think we've all seen that with where oil prices have gone on the back of the invasion in Ukraine. And then obviously new and used cars, still a major driver, but is starting to come down slightly. So that's good. Obviously, we talked about jobs market. That's going to play into inflation with the wage inflation going up. And then obviously housing. Housing continues to be a bigger driver of inflation, and the housing market is strong, but we're starting to see some softening in prices, and also driven by high prices, but then also higher mortgage rates are really starting to price people out.
Right.
And we're as you'll see, there's more demand coming online. So I think housing is going to start softening a little bit, which will be good for inflation. The primary drivers of the inflation, though, is still really the base effect, which we'll talk about in a second, and the supply chain management issues that have now been exacerbated by COVID, increasing in China, and so it's
right. Simultaneously, we got all this weird stuff in Shanghai, and we also can't get crude, nat gas, wheat, and fertilizer out of Eastern Europe.
Exactly. Yeah. So it's the supply chain issues, which I thought were going to be kind of gone by this point, or maybe by the middle of this year, are probably going to extend out farther. Broadly speaking, long-term perspective, I think that the secular disinflationary trends, forces are still there, right? Technology, globalization, aging demographics, those things will still push down inflation over the long run. And so that's just something to keep in mind. Here are the numbers. Headline, right? 8.5%, core inflation, 6.5%. Let's dig into this a little bit. Here's the headline inflation numbers. This is analysis that we do in-house here based on the statistics that come out of the Bureau of Labor Statistics. But if you look and we break this down by weightings, and then we try to understand and pick apart what's really driving the inflation numbers. So for headline inflation, you look here and you see energy 7.5% weighting, but it makes up almost a third of the inflation number. That will get better at some point, right? And so whether it's a year from now or whether it's 6 months from now, this will end up getting better, and that driver will go away. Same thing for used cars and trucks, 4.2% weighting, yet it makes up almost 20% of the overall inflation number. So those two factors alone make up almost half of the overall 8.5%. And those are two factors that I think are going to change. If you fast forward 12 months from now, I think those will be a much lower impact.
Well, and I'm going to show you a chart in a minute that shows that we just saw the largest drop in vehicle prices in 30 days in U.S. history since the data's been recorded. So we're finally picking up some easing already, actually.
Yeah, exactly. Looking at core inflation, some of the things we already talked about. We talked about used cars and trucks, 5.3% weighting, but almost 30% of the core inflation number. New vehicles also seeing high inflation. It's a 5.1% weighting, but makes up almost 10% of the overall inflation number. And then we're seeing a little bit of this broadening that I talked about. Airline fares, it's almost 0.5% of the weighting, yet made up 2.3% of the overall inflation number.
That's incredible. That's a major magnification, right?
Big, big change. The things that people are really feeling now, shelter makes up 41%, and at an inflation number of 5%, that's definitely much higher than what we've seen in the past. And so that's what I'm talking about here with the broadening. And we can go back here, looking at food, right? Almost 9% on food year over year. So we're starting to see a broadening of the inflation numbers, but a lot of the main drivers of inflation over the next 6 to 12 months are going to improve. This just shows you your crude oil. If you just look over the last year, all right. If you look over the last year, you can see that oil was about $60, and now oil is $100. And so that in and of itself, that's the base effect that I'm talking about. Where if you fast forward 1 year, and if oil is still at $100, then inflation driven by oil is going to be zero, and that's going to have an impact. Okay, I'll turn it back over.
Okay, all right. Let's go through a few more things that we're seeing that we don't like. I mean, we really needed wage increases in this country. That's a big deal, right? The lower income groups were not participating in this 13-year long economic expansion, right? So it came and they were getting paid more, but now inflation is so high that net they're going backwards now the last 2 quarters, right? So that's not good. That's a problem. This U.S. job openings, right? Anytime job openings are moving higher, that's a sign of an expanding and a growing economy, right? Okay, this is insanity. Look at this vertical hook here coming out of COVID. The problem is we went from just normal economic expansion to shortages of labor. Okay, that's a problem, right? That's one of the things that's sort of leading to this. We had a lot of early retirements. We had 5 years of retirements in 18 months through COVID. So that was number one. Number two, we have a lot of people not trained for the jobs that are open in this country, right? So Washington needs to help. I don't put any faith in them. The market's having a hard time sort of working this out on its own is sort of this labor problem. Another thing that's starting to get some attention and could get worse is the wheat situation, depending on how long the conflict goes in Ukraine, right? These two countries, look at that, are about a third of the global wheat exports. Okay, the good thing about this is it's not a real-time world. People do stockpile wheat to a certain extent. If this goes on for very long, 6 months or more, Africa is going to have a real problem on their hands. Okay, we're going to see a lot more social unrest and things like that. So another reason, besides all the humanitarian reasons, we've got to get this thing worked out, get Russia out of Ukraine and get on with this. Fertilizer prices, right? Russia's a massive supplier of fertilizer inputs. That's a problem. So our farmers are facing higher nat gas costs, higher regular gas costs, higher fertilizer costs, et cetera, right? So this is one of the reasons you're seeing food go up so much is a lot of the inputs are going up. We haven't seen this in a while. This is S&P 500 companies, right? Big corporations here revising down earnings estimates. We have been on a blistering growth trajectory. And now over the last 8 weeks, you're hearing from a lot of companies saying, hey, listen, we're growing fast, but not as fast. Things are getting more expensive. We're just not pushing as much to the bottom line. Now, so far, the good thing is this. The reduction in earnings so far is very small. So a lot of companies are saying we're not going to do quite as well, but the number is not big. It's a little higher than this now. It's a little bit over 2% now. So look, we want to watch this really close because this is a massive driver of stock prices, is really watching that sales and earnings data that we're getting from our publicly traded corporations, right? So far, it's mattering, but it's not mattering a lot yet, right? And if Josh is right, and some of this ends up being a little bit transitory, some of this inflation we kind of work off and get rid of as the year goes on, I think we're probably in for a decently soft landing in terms of slowing the economy down, right? I don't like this. This is another problem. A lot of you have stock portfolios, okay? And the S&P 500 garners all the attention, right? Okay, this is the highest weighting ever for the top 6 stocks in the S&P 500. So those 6 companies now make up basically a quarter of the S&P 500. That's a problem. It's a problem for a couple of reasons. Number one, too many people have fallen in love with these darlings. They're big tech companies. They're growing like crazy. They are incredible and phenomenal, but you've got to be careful that that's your whole portfolio. I'm going to show you why in a second. The second thing is too many people are judging their portfolio's quality based on the performance of the S&P 500. I'm going to tell you, you and me probably don't want a retirement portfolio that looks just like the S&P 500. That's probably not what we want. So be careful, because sometimes your portfolio might underperform. Sometimes it might outperform the S&P 500. Be careful reading too much into that, especially when the S&P 500 is being so dominated by just a very small handful of companies. Okay, so I kind of wanted to throw that out there. Okay, this is why you don't want to fall in love with even the best companies. You need to be emotionally detached from this and look at things on their merits, right? Okay, so this is the top 5 companies. In 2000, the top 5 companies were 18% of the S&P 500. Today, the top 5 are about 22% of the S&P 500. Okay, if you had bought these companies in 2000, they all have grown their earnings and their sales big. These 5 companies are much, much larger than they were in 2000. But look, 3 of the 5, the stock prices are still lower than the year 2000. So you bought these 5 in 2000. 22 years later, you were completely correct in your investment thesis on those companies, and you still have lost money. right? This is why you have to be so careful. These companies are clearly amazing companies, right? But it might not be the best portfolio. And that's why, having money managers to find value in places that you might not be reading in the headlines can be so powerful for you in time. So be a little bit careful with that. Okay, let's pivot. Let's start talking about the good stuff, okay? And there's a lot of really good things. And a lot of this is the stuff you're not going to see on the evening news, right? So let's start with earnings. As much as inflation and interest rates have gone up, our US corporations, especially our larger corporations, are absolutely minting money. It's insane. Since the financial crisis, these companies, these 500 companies, have grown their earnings over 900%. It's a record. You can't find a 13-year window since the data has been recorded since the Great Depression where you have grown the biggest companies at this kind of clip. It's staggering. And we've talked about everything from COVID to world wars to inflation to whatever you want. And look at this trajectory. It's really, really, really impressive. And by the way, you can't make that up. That's not spin, right? That's not narrative. These are real, actual cash earnings that these companies generate. Let me tell you another thing nobody talks about. If you turn on the news, you read the Wall Street Journal or whatever, what do you hear constantly? Debt, 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 debt. We're selling debt. Okay, this is not true. There are three groups that borrow in the United States: the government, corporations, and households, individuals, right? The government is who is borrowing all of the money, okay? The corporations and the households are not. So what you're looking at on the screen here is something you don't hear about, okay? We are at a multi-decade low in the amount of money that the average American is spending on debt, okay? Look at this. Look at this. We are in precisely the opposite position that we were going into the financial crisis. The average household is at a 50-year low in the amount of debt that they're using in relation to their net worth. So while net worth doubled, more than doubled in 13 years, you actually had a reduction in debt. So in other words, your balance sheet looks markedly better than it has in 50 years. I mean, that's a big deal. Primarily because two reasons. Number one, it allows American corporations and households to weather storms better. Okay. So let's say we have a recession next year. This allows you to weather the storm better. And number two, this money, a lot of it is going to be reinvested at some point, offering a tailwind to risk assets. So right now, we are sitting at a record amount of cash in bank accounts. Both corporate and household bank accounts have never held so much cash as a percentage of the size of the US economy. It's massive. It was already on a northward trajectory. We already had a lot of nervousness from Trump to Biden to all these other issues. And then you add on top of it COVID, and now you add on top of it wars, right? People stockpiling cash. Here's another way of looking at the same chart, okay? Look at how little cash was held in checking accounts and cash in 08. This is why 08 was such a disaster, because the world starts falling apart and no one's got any cash to do anything with, right? Well, we are in precisely the opposite position now, right? So now whatever stress you may find, there's a truckload of cash on the sidelines waiting to pick up opportunistic investments, right? Here's another way of looking at it, okay? Here's your two biggest lenders in the United States, JP Morgan and Wells Fargo. They both increased their loans by a normal and healthy amount at the end of last year, but they received 3 times as many deposits as what they lent out. So the banks they don't know what to do with their cash. The balance sheets of banks have not been this good in 40 or 50 years, depending on the data and the metrics that you use. The banks don't know what to do with all the money, right? So this is a big deal. Profit margins continue. As much as inflation has been a problem the last year, margins are down a little bit off boil. They're probably going to come down a little bit more. But I've been doing this now this is my 30th year working in this business. And my whole career, I've heard everybody say margins can't expand. Margins can't expand. Well, when you are adding technology to great companies, you can get more and more and more efficiency out of those businesses. Some of you have heard me share in the past that 25 years ago, for every $1 million in sales, you needed 8 employees. Okay, today you need 2. Okay, for every $1 million in sales, just 25 years ago. You think about how much that's changed and how efficient our companies are. And why do we obsess so much about these earnings? We're always talking about earnings. It's like always the number one thing when we're talking about our economy, our stock market, et cetera, because it ultimately is the barometer. It's the arbiter here. If you go back to World War II, look at the correlation between earnings of companies and the stock price of the companies. I mean, say what you will, they decouple for windows of time. But look at that. What is that? 75, 80 years of history, almost a one-to-one relationship. So when you invest in a great portfolio of companies, even if they're private companies, right, through private equity and things like this, you really truly are investing in the long run ability for these companies to generate earnings. And do you think that changes because Putin invades Ukraine? Do I come in this morning and work differently at my company because of things like that? That's why investments have to be non-emotional, because in time, people that own businesses do everything in their power to make those businesses better. Okay. All right, another good thing. We're about to see some help in housing. Okay. Building permits really spiking, right? Look at this. This is housing units under construction right now in this country. 50-year high, right? After working off the second low ever, we see this gap. This gap is the problem. That gap is why there's no houses to buy. So we are playing catch up, right? These are housing units that are authorized and not even started, also 50-year high. So 12 to 18 months from now, our supply picture in housing is going to be radically different in this country. Okay, you couple that with what Josh said a little while ago, you got mortgage rates doubling in 90 days. By the way, the fastest 90-day ramp in mortgages ever in the United States on a percentage basis, right? So mortgage apps, look at this. Look at that. That's incredible, right? So mortgage applications have really, really slowed. And what's the good news? The good news is I'm still getting a 30-year mortgage for 5%, right? Which in the history of the United States, there's been like 5 minutes of time where you could get a mortgage for 5% or less, right? So the cost of capital is still incredibly low, but it has moved up quickly. And that is helping the housing market find more of an equilibrium. Okay, so let's talk about something that I'm not hearing enough of right now in the media. The media really is sensationalizing the inflation and interest rate story. And Josh is going to come back in here in a second and talk about more of that. Okay. What they're not talking about is the economy is already cooling off on its own. So our investment committee feels pretty strongly that the Federal Reserve is not going to have to bludgeon the capital markets with rate hikes to get the economy to cool off. And this is one of the rare periods of time where cooling is a good thing. Okay. This was the week before Ukraine was invaded. Leading economic indicators were already coming down. So don't blame it on the war, right? Remember how coming out of COVID, there was no inventories because there was no shipping, right? Look now, outside of vehicles, there's lots of inventory suddenly sitting everywhere. And you and I both know what that does for pricing. That eases pricing, right? Look at this one. 50 years since used cars have had a 30-day drop like they just had. We needed this bad for a whole host of reasons. We needed this. This isn't even in the data. This is not even being picked up yet.
Yeah, it takes a couple months for it to flow through to inflation.
Exactly. So this is going to come up in the inflation data. Since March 8th, okay, after the war kind of got a little bit scarier, we've seen a 16% decline in U.S. shipping volume. Okay, shipping volume is a really direct barometer of business owners ordering stuff. Okay, so why do business owners stop ordering stuff? Inventories went up, demand starts slowing, right? And these are the leading indicators we're talking about, right? So these are the kinds of things showing you the Fed is not going to have to bludgeon us and put us into a recession. Port traffic. We're getting back to more normal areas like at the LA port, right? Remember how we were talking about several weeks to offload your cargo last year? Here's the price to get a container from China to New York. Look what it's doing, right? It's down 50% in 90 days. That's a big deal, right? Again, not talking about that on the nightly news, right? Lumber coming in aggressively all of a sudden because of the slowdown in mortgage applications. And a lot of houses are already underway being built. They've already ordered their lumber, right? Small business owners, they're feeling negative all of a sudden. They're feeling bad with all of this inflation and higher wages, right? So in the last 30 years, there's only been 2 other periods where small business owners have felt as pessimistic as they do right now. Okay. I'm saying that like it's a good thing. Why? Because usually this becomes a great time to invest in good businesses and good assets, right? You want to be investing when people feel pessimistic. Remember '08? How much would you give now to go back and invest in a stock portfolio in the fall of '08, right? Or how about in April of 20 when COVID hit, right? So we're getting back to some real pessimism. Look at this one, okay? This is the oldest running economic survey in the United States. It's done by the University of Michigan. Everybody on here has heard of the Consumer Sentiment Index, right? Coming out of the University of Michigan. They do this monthly. Okay, if you look at this chart, now we could overlay this to all kinds of things, bonds, private equity, all sorts of different assets, but this happens to be overlaid with stocks, okay, with the S&P 500. Well, it probably doesn't surprise you that many of the very best times to invest is when people feel really pessimistic, right? We're going around right now over the last 8 weeks, people are kind of heavy. There's a heaviness, right? And so we actually think we're starting to work through the problems and probably want to be sharpening our pencil about the kinds of assets we want to buy while we have an opportunity here, right? Remember all that cash on the sidelines. We still have really low interest rates overall, even though they've gone up, right? There's a lot of tailwinds to this economy. Okay, so now what? Okay, so if you, whatever stock market barometer you want to look at here, they're not down that much from their high, right? The high was really basically the first of the year. But look at what the average stocks have done. Okay, the average stock is down a lot more than the indexes themselves. My point in sharing this is that a lot of the heavy lifting and ugly work has already been done. This market mostly has been in a bear market. We've been hit pretty hard, actually, year to date. A lot of you are clients of ours already, so you know we're a little bit anal about high quality assets. I know that seems like a really stupid name. It actually has a mathematical definition in our business. High quality companies are ones that they don't use a lot of debt. They have a lot of free cash flow. They can really weather rough economic storms, unlike what you're looking at on your screen, okay, which is the opposite. And this is a couple weeks old, the numbers here, but it proves the point. 1 year ago, everybody loved SPACs, meme stocks, companies with no sales, but a lot of promise, a lot of crypto. Look, if you've built a large portfolio of these assets, you have been absolutely taken out in a body bag over the last 12 months. It's been a really important reminder of how you want to build a portfolio. Everything on this screen might make sense in some part of your portfolio. But if this is the foundation, you got murdered. So again, when you hear us or your advisors or whoever it is talking about owning high quality assets, that's the real deal. Look at this. This is over 1 year. And this is drawdowns of companies, the 3,000 biggest companies in the United States, okay? In 5 buckets, okay? The lowest profit margin companies in the past year, they dropped an average of 58% from their high, as compared to the highest profit margin companies, we're only down about 18% at worst from their highs, right? That's a big deal. But here's the problem. There are times that these companies are the best performers. So there were parts of last year where you actually might have thought, hey, my portfolio is not doing as well. But that's because these were thriving. But when times get hard, you want to be up in here, right? And so that's why, going back to what I was saying earlier, be careful making something like the S&P 500 or some other random index your barometer of success. The nature of your assets and how they perform for you, that ends up being the adjusted definition of success for you, right? Equities are getting cheaper. We needed this bad. We have finally come off boil. So you not only have prices have come down in stocks, but earnings kept going up, which means that the stocks themselves actually got cheaper. So we're not down that much, but the market actually got a fair amount cheaper. Even the tech companies, even those high flyers are getting back, not cheap by any stretch of the imagination, but not insane like they were, right? Small caps rarely get this cheap. Small caps have really been taken to the woodshed. There's a lot of interesting things starting to pop up. And some of our money managers that we're talking to in small caps, they haven't seen opportunities like this more than a handful of times their whole career. But even fund managers, I talked about small business owners, but even fund managers are reporting a lot of pessimism. Historically, when fund managers in our country get this negative, they have really been exceptional times to be in buying. And so, it's really funny because professionals act like guys like me, right? You're listening to me like, oh, he acts like he totally knows everything that's going on. When 30 years ago, I was a trader on the floor of the New York Stock Exchange. Those guys are not immune to feeling emotional, right? So even veterans in this business can let the emotions get the better of them, right? So we're having a lot of people in the last 8 weeks. Really, a lot of what we're hearing is very pessimistic. And actually, what's interesting is the data is coming our way. We actually think it's actually getting better and more interesting. So in terms of looking forward, one of the big deals is what's the Fed going to do? So Josh, why don't we take a minute, talk about rates and bonds and the Fed, and kind of, because that's so much of what's going to be the driver in the next 6 months of what's going on.
Yeah, for sure. So let's jump into just what's going on with treasuries. So what we've seen, you see here, this line here, that's 1 year ago, that's the yield curve. This is 1 quarter ago. So even from 1 year and 1 quarter ago, we've had a massive shift in what's going on in treasuries. So you've had this significant steepening on the front of the curve. And this is in response to the Fed becoming more hawkish, or the expectation that the Fed is going to increase interest rates. And then you've had a massive shift here on the long end of the curve, and a flattening. So a shift up and a flattening in response to the Fed, or the expectation that the Fed's going to be increasing interest rates. So let's talk about just what's happened in different areas of the fixed income space. Obviously, this has been a very painful quarter for anybody who's invested in bonds. It doesn't matter whether you invested in high yield, whether you invested in investment grade, whether you invested in mortgage-backed securities. Everybody has felt the pain of investing in bonds, but that has provided an opportunity, I think, to invest at more attractive yields. Specifically, we as a team feel like municipal bonds look very attractive from a risk versus return perspective, even for clients in lower tax brackets. And the sell-off in muni bonds has really been driven by 2 things. The fact that municipal bonds are longer duration, and they're a little bit more sensitive because you have retail clients who are trying to escape this rising rate environment. So that's created a very, I think, unique opportunity to invest in municipal bonds. Investment grade corporate bonds, thinking about the spread over treasuries that corporate bonds pay you, there's been a pretty significant repricing over the last quarter, and those, you're getting paid about 30 basis points or 0.3% more than the 5-year average that we've seen over the last 5 years. So that means even investment grade bonds are starting to look a little bit more attractive compared to what they were last year. High yield spreads have normalized towards their kind of longer term average. They're still a little bit tight, about 20 basis points or 2.2% lower than their 5-year average. But given what we expect with interest rates and the interest rate hikes and the current yield on high yield, we still think that high yield is a good place to be, assuming that we don't have a massive dislocation in the market. High yield, I would expect, would outperform investment grade corporate bonds through the rest of this year. Let's talk about what's going on in the Federal Reserve. For the Federal Reserve, there's been a lot of changes. And I'll show you some charts. There's been a massive shift in sentiment by the members of the Fed, and I'll show you in my next chart. But the big things that are happening, members have become much more aggressive, much more hawkish when it comes to raising rates. All of them are generally agreeing that they need to pull back the balance sheet. So they need to reduce quantitative easing, which they've already started to do. And then over the next 3 months, and so the expectation is that starting in May, over a 3-month period, they're going to be reducing the balance sheet with kind of a terminal after that 3 months of about shrinking it by about 95 billion a month. So just to kind of understand how much that is, that's about twice what they were reducing the balance sheet between 2017 and 2019. And they're breaking that out, 60 billion in treasuries, 35 billion in mortgage-backed securities. Now, I want to be clear, there's a difference between the Fed reducing the balance sheet through selling assets and them just letting assets mature and roll off and not buy more. And the Fed is what they're doing is they're not selling assets. There's a big difference.
Right.
They're just going to let things mature and they're going to let things roll off with a max of about 95 billion is what the expectation is. We're likely to see a 50 basis point hike in May.
And by the way, to show you how dovish they are about this, in the last several weeks, they've still been adding to the balance sheet.
Oh yeah. They're still,
not a lot,
they're still,
but so the Fed is showing their hand. Look, we may raise rates.
Yeah.
But we're not going to let the balance sheet just unwind and get crazy.
No.
Like they're indicating, look, we're going to provide accommodation as needed.
Yeah.
You know.
Yeah, for sure. And the reality is they probably would have hiked by 50 basis points last time
if not for Ukraine.
If not
right?
for Ukraine.
Yeah.
So I think this is well within expectations. And the reality is Powell still talks about inflation, and he still talks about it from the framework that they think inflation is going to improve in the latter half of this year,
right?
Which will create an environment where the Fed potentially is not going to have to hike as many times as they're
and isn't one of the reasons that the curve is so flat on the back end is a lot of people think maybe next year cuts will come. That maybe the Fed, there seems to be a really loud group saying, we think you have to rip them higher this year and then get off the gas next year. Like that, a lot of people are sort of pricing that in.
Yeah,
you know?
Yeah. There's definitely that potential for sure, especially if maybe they over hike,
right?
And then they need to kind of pull back, similar to what was happening in 2018, where I think the Fed went too far.
Right.
The markets really responded strongly. For those who were in the markets in December 2018, not a fun time. And that was in response to the Fed, I think, getting too hawkish. So I think this is a really interesting chart. So what this shows is the evolution of the Fed's views of their interest rate hikes. So if you look here, so you've got March 21, this is the median policy rate projection. So the Fed comes together and they say, hey, this is how much we think rates are going to be so for 2021, in early 2021, they thought rates were going to be at zero, which they were. In 2022, they thought rates were basically going to be at zero. And then they thought that rates were going to be at zero in 2023. Now you go to the next meeting, June of 21, and suddenly they're shifting their thoughts farther out, right? So 2021, they're like, yeah, it's still going to be zero. 2022, we think it's still going to be zero, but we think in 2023, we're going to start hiking. So that's where you have that. Then by September, still, they think, oh, we're not going to hike, but we think we are going to actually hike in 2022. And we're going to hike more in 2023. And we're going to hike even more in 2024. Then come December, there's a massive shift. And suddenly they're like, hey, we're not going to hike right now, but we are for sure going to hike and we're going to get aggressive in 2022. And we're going to get even more aggressive. Anyway, you see the chart, right?
Yeah.
But then now there's even bigger shift in February. Now they expect to hike twice as much as they were just from the December meeting for 2022. And then obviously, right, a bigger shift here.
Yeah.
So this shows the evolution of the federal members thinking about interest rates. And so right now, they think that they're going to hike the Fed funds rate a little bit below 2% is what their expectation is. But look at what the market's expecting. The market's expecting that by the end of 2022, the Fed will have increased interest rates to north of 2.5%.
Right.
So even more. So the market's really based on the Fed funds futures, the market's implying that they're actually going to increase interest rates even more.
Right. Like 10 hikes are basically priced in.
Basically, almost 10 hikes based on 25 basis point hikes, right? So so there's a big disconnect, I think, is what I'm trying to get at between what the markets thinks and what the Fed thinks, which creates a very unique opportunity because I think a lot of people have kind of given up on growth because in a rising rate environment, growth typically underperforms for short periods of time. But the reality is that if you look back, and we don't have a ton of data because the dot plots, which is what this is based on, really started in 2012. But if we look back to the last hiking cycle, which was started December of 2015, and we see what the Fed expected versus what actually happened, I think it's very telling. The Fed expected, so if you go back to the meeting, December 2015, the Fed met and they said, hey, we think that Fed funds rate is going to be 1.375% by the end of 2016. We think by the end of 2017, we're going to be at 2.375%. And by the end of 2018, we're going to be at 3.25%. In reality, what actually happened? 0.75% 2016, 1.5% 2017, and 2.5% 2018, which really was a mistake.
Yeah.
If you remember, they hiked in December.
Went too far.
2018 went too far.
Yeah.
The markets puked. And then they started to have to decrease interest rates after that.
Right.
So I think that the point that I'm trying to make here is that, yes, there's all these wild projections about where interest rates are going, but the reality is the Fed is probably going to hike less than what they're posturing.
Yeah.
And it's probably going to be less than what the market's implying right now.
Which is totally fine, because the point is to get the economy to slow, but not put it in a recession.
Exactly.
And Powell's been pretty good about doing something and then waiting. And so you're probably going to see like a 50 basis point hike and then some waiting, because I just showed you a bunch of data showing the economy is already kind of starting to cool under the hood a little bit on its own.
Yeah.
Right. So we could very easily, we might do 10 rate hikes this year, but we could do 3, have the work be done, right? Housing cools, autos cool, food cools.
And inflation starts getting more moderate, and then suddenly they can justify pulling back on those expectations a little bit.
Yeah, I will tell you, I don't have the chart in here, but I was just looking at some stuff last night that was showing that at around this point in prior cycles, when the market is overpricing how much the Fed's going to tighten, growth stocks from that point forward outperformed in a huge way.
And it doesn't surprise me, because I think that the market's getting ahead of itself.
Right.
And I think things are starting to slow, and consumers are starting to feel the pressure from inflation. So they're going to pull back a little bit on spending. That's going to kind of slow the economy even more.
Yeah.
And then I think the inflation picture, now, I mean, the reality is, inflation at the end of this year is still going to be probably mid-single digits.
Sure.
Which does not feel good.
Right.
But I would rather take 5% inflation than 8.5%
Right.
inflation.
Right.
And once you start getting into 2023, it will get even better.
Right.
You'll see a more normalized 3 to 4% in 2023.
When you probably are going to have help from things being done in China and over, things being done in Ukraine and over. You're probably going to have help from all of that supply chain side stuff. Okay. In closing, just, some things to remember. The market had a 15% pullback in the S&P 500 here in this last quarter. It's normal. Every couple of years, this is what we get. It's totally normal. Most years, the stock market is higher, but the red dots will show you how much during the year the market has dropped. So, if you when we want to make money and take risk, right, that you're going to have these nasty windows that we sort of have to deal with along the way, right? Some things that should, I find pretty compelling. I started working in the business here. So I've been through about 25 corrections in the stock market, and it never, ever feels good when it's happening, ever, for anybody, right? And the average pullback is about that much. And we just about got to that average pullback in March, right? But look at what the market does 1 year and 2 years later, right? 25% gain in a year and 37% gain in 2 years. That's powerful, right? I mean, so at the times that we all feel the heaviest and the worst are clearly the times we want to be buying high quality assets, right? Midterm years, for some wild reason, are the worst, right? The average pullback in a midterm year is way worse than the average year. But look at the 1 year return after that is actually really, really high as people get more clarity in the fall after the elections, right? So there's a lot of cross currents this year that we're going to deal with. Another thing is everybody thinks that when the Fed is hiking, it's bad for stocks. That's actually not true. If you go back to World War II and you look at all of the periods where the Fed has been hiking, most of them, with the exception of this nasty 70s series, have actually been pretty good. And again, it goes back to what we said earlier. The Fed is hiking because the economy is good, right? The Fed and inflation are indicative of a lot of good things. That's actually what's happening. We just have to get the right balance in cooling it off, right? I do want to make another note about this idea of growth stocks and value stocks and things like this. And I just wanted you to see the data, right? Because a lot of you own both in your portfolio. Well, what do growth stocks as a group and value stocks as a group in this country look like? Okay, first of all, growth stocks are a lot more expensive. You got to pay more per share to own growth companies, right? But what do you get, right? So the average growth stock in the United States has grown earnings for 5 years at 20% a year. And the average value stock has actually shrunk a little bit. Earnings are actually down over 5 years, right? Sales growth, right? 18 times higher sales growth with growth companies, right? And then cash flow growth, right? 20 times higher cash flow growth, right? So when you build a portfolio, you need both, right? You need some of these companies that are sort of these old guard, high value, banks and consumer staples companies, and some of the oil companies fall into that category, and some of these things. And then you need some of these high growth, right? Healthcare, technology, and things like that. That's why you have a balanced portfolio. But the nature of those companies are quite different, right? So let's close with this. We kind of went through the checklist of things we like and what we worry about. Some of these things are getting better. Investor complacency is getting better. Markets are getting cheaper. We aren't seeing nearly as many excesses. There's not nearly as much trading in the junky assets as there were. We are working through Putin inflation, Fed. We're working through a lot of that right now, but we have a lot of very, very powerful, strong fundamental factors behind us. So here's kind of our working thesis. And this is sort of the checklist and the takeaway, right? The economy is already slowing on its own. You're not hearing that a lot. We think it's happening. Not a lot, but it is slowing. And the Fed has just been jawboning at this point and has done one small rate hike. We don't think the Fed needs to go the full 10 rate hikes. As a committee, we're pretty convinced you're somewhere south of that. That organically the work gets done sort of on its own. So we don't think the Fed is going to over tighten. They've proven how dovish they will be when they need to be that way. We kind of think that 2022, I don't want to put too rosy of a scenario on this. We kind of think it's the pause that refreshes. We kind of think that this is a re-rating right now, and that you're going to want to be sharpening your pencil and owning really good growth assets coming out of the year, whether that's at this minute or through the summer or however you and your advisors strategize that. We think there are going to be some of these inflationary pressures that last a little longer because of a variety of either supply chain issues or what's going on in Eastern Europe and commodities and things like that. That's going to be the bugaboo, right? We're going to have some of these commodity disruptions that are going to hurt inflation here for a little bit longer. We got to run a little hotter on inflation probably. But we think most of the supply chain issues, they have actually been improving. And as soon as we can get China and Shanghai out of this zero COVID insanity, we can kind of get back to loosening up the supply chain a little bit. I think earnings are going to have to go a little lower. We think earnings expectations, they're coming down. They probably have to come down a little more. Inflation's a little hotter. We don't think it's in the data yet. So you're still going to be seeing a lot of earnings growth, just not as much growth as originally anticipated. We think the housing shortage, I talked about that. We think it gets better, that we're going to start finding an equilibrium real soon here. We probably already are finding it in housing, more of a two-way market. And a lot of stocks could work lower, obviously, but we think a lot of the damage has actually already been done. So in terms of the game plan, you obviously want to be rebalancing your portfolio as you need to. We saw too many people giving up on good assets. People gave up on value stocks for 10 years, or they gave up on bonds entirely because interest rates were low. You still need a healthy, balanced portfolio. And for anybody, there is a role in your portfolio for conservative assets and growth assets. The question is how much? And that's what a good advisor will help you work out, is right sizing these good assets, right? Avoid complacency. Let's say things get really good again here and the markets are just screaming and ripping. I always see people make the biggest investment mistakes in good times because they get cocky, they get complacent, they invest in things they wouldn't normally invest in. This is not a time for that. Okay. This is a time for knowing what you own and why you own it. Really high quality assets, right? And there's going to be certain markets where maybe you make a little less money because the junky assets are ripping. That's okay, right? If we, at some point in the future, we're going to go through another nasty recession with lots of bankruptcies and all kinds of things. And you're going to want to know and sleep well with what you own, right? The volatility finally came. We've been beating this drum for, a year and a half. We're seeing it. The market didn't really have a lot of volatility last year. So far this year, It's wild, up, down, every direction. That's probably going to continue for a while because we have a lot of crosswinds we've got to work out. You consider alternatives types of investments. There's a lot of interesting things that don't trade publicly. Talk to your advisor about that, right? There are interesting other types of assets right there, and take advantage of the volatility, right? If you have taxable accounts, sometimes you can harvest some losers on purpose, put those in your pocket, lower your tax bill today or in the future, right? When things go on sale, I talked about small caps earlier and how we're seeing some very interesting high growth companies trading, cheaply. So anyways, Josh, any final thoughts or words or anything?
No.
Okay. I know we covered a lot. We're going to go ahead and send this out to whoever invited you to the call and to yourselves. We'll have a copy of the replay of this plus the slides on this. Obviously, feel free to forward it to anybody that you want and share it. And again, for a lot of you that are clients, we're just really grateful for the trust that you place in us and letting us be a part of you building a portfolio for you. And we hope the information's helpful and look forward to seeing you as we're out on the road and talking to clients this year. So have a great week, and we'll talk soon.